Did you know that for resident Indians, the income tax department can send a notice of any discrepancy found in the last 4 financial years filing? But for NRIs, the same tenure is 14 years. So, in many cases, the government of India treats NRI differently. Filing an ITR in India as an NRI can be complex, and from my experience of serving NRIs, here are some common errors I have come across which you should avoid while filing your ITR in India. Number 1. Failure to file income taxes. Now, some NRIs incorrectly believe that they don't have to file income tax in India because their income is below the taxable threshold. However, it is advisable to file income tax returns even if your income is below the taxable limit to avoid any potential issues in the future. Now, for concepts like deemed rental income, provisions require for an individual to file ITR and pay taxes even if they have actually not received the income in their accounts. Number 2. Ignoring tax residency rules. Sometimes NRI fail to correctly determine their tax residency status. Now, this can have significant implications on your tax liability also. NRI can check their tax residency status by considering the following factors. A. Physical presence. Now, the number of days an individual spends in India during a financial year is a significant factor in determining tax residency status. The income tax laws in India classify individuals into 3 categories based on their physical presence: resident, non-resident, and not ordinary resident. B. Employment and business activity. Now, NRIs engaged in employment or business activities in India need to consider the impact on their tax residency status. The nature and duration of employment or business activities can influence the determination of your tax residency. C. Tiebreaker rules. In cases where an individual qualifies as a resident in more than one country, tax treaties often incorporate tiebreaker rules. Now, these rules consider factors such as permanent home, center of vital interests, and nationality to determine the tax residency status. And D. Residential status. The residential status of an individual is determined by the number of days spent in India during the previous financial year and the preceding years. The specific criteria vary depending on various factors, including citizenship, employment, and intention to stay in India. Ensure that the tax residency rules are taken care of to avoid any penalties or unnecessary tax burdens. Number 3. Incorrect bank account details. Ensure that you provide accurate bank details, especially if you have an NRI and NRO account. It's essential to distinguish between the 2 types of accounts as they have different tax implications. Most importantly, only NRO account is eligible for claiming your tax refunds. Number 4. Not claiming deductions and exemptions. NRIs are eligible for certain deductions and exemptions under the Income Tax Act. Such deductions under the Section 80D, 80C, and others are available. Failing to claim these deductions can result in overpayment of taxes. Now, when it comes to long-term capital gains, NRIs have the opportunity to benefit from exemptions under specific sections of Income Tax Act. These sections are 54, 54EC, and 54F, which offer various exemptions for capital gain taxes. Number 5. Late filing and penalties. NRI should be aware of the filing deadlines of ITRs in India. Filing your income tax return late can result in penalties and also interest on unpaid taxes. Ignorance of the law is never an excuse. Point number 6. Incorrect form selection. Choosing the wrong ITR form is a common mistake. NRIs who pay taxes on their own should select the appropriate ITR form based on their income sources and residential status. Number 7. Overlooking double taxation avoidance agreements. These DTAA are bilateral agreements signed between 2 countries, which is in our case India and other country, to prevent double taxation for NRIs. Now, ignoring the provisions of DTAA can result in NRIs paying taxes both in India as well as their country of residence. NRIs must understand and leverage the benefits of DTAA to avoid double taxation and reduce the tax liability. Number 8. Incorrect classification of income. Proper classification of income is critical for accurate tax filing. NRIs often struggle with classifying their income correctly, especially when it comes to differentiating between taxable and non-taxable income. Errors in income classification can lead to incorrect tax calculation and potential legal issues. It is advisable to seek professional advice or refer to a relevant tax guideline to ensure accurate income tax classification. Number 9. Neglecting tax planning. Now, proper tax planning is crucial for NRIs to optimize their tax liabilities. Many NRIs fail to engage in tax planning activities, resulting in missed opportunities of tax saving. By strategically planning their investments, utilizing tax efficient instruments, and staying updated with the tax law changes, NRIs can minimize their tax burden and maximize their returns. Number 10. Not maintaining proper documentation. Maintaining comprehensive documentation is very essential for NRIs during tax filing. Failure to keep records of income, expenses, investments, and other financial transactions can create challenges during the filing process. NRIs should maintain organized and accurate documentation to support their claims and substantiate any deductions or exemptions. Number 11. Not filing revised tax returns. NRIs who have made errors or omissions in their tax returns are required to file revised tax returns to correct them. Failure to file revised tax returns can lead to addition of income, penalties, and legal issues. Number 12. Not seeking professional guidance. Tax laws can be complex and they may change over time. Seeking professional guidance from an advisor who specializes in NRI services can help you navigate the process and ensure compliances with current tax regulations. In addition, you get time-bound correct advice. Here at NRI Money with Alok, I am committed to helping you making informed and strategic financial decisions. Drop your questions and experiences in the comment section below. Until next time.